is now a good time to buy or now a good time to sell?
Isn't
right?
that the $1 million question about everything?
Or the $1 billion question.
Even about houses, right? Like we get that farmland, you get that real estate.
Right.
Is now good. What about interest rates? Thank you for tuning in to today's Land and Everything Else podcast. We are in the heart of Chicago. So if there's some sirens or screaming folks, we'll do our best on that end. But I'm here with a fantastic, awesome guest today, Michael Stockburger, who runs the row crops, U.S. row crops for Nuveen, and we are so happy to have you.
Happy to be here.
Well,
thanks for the embellishment.
Oh my gosh, no, we're very pumped, and thank you for coming out. This makes it so much more
You're
fun.
welcome.
So I just want to kick off with if you could share a little bit about who you are and what you do.
Sure. I will give you a quick glimpse. I don't find it all that exciting. I'll let you be the judge of it. But Michael Stockburger, I do run our U.S. row crops team as part of Nuveen Natural Capital. We manage about 300,000 acres from coast to coast. It's about a quarter of our assets under management. We've got a phenomenal team kind of scattered around the country. Personally grew up in Virginia, been in Memphis, Tennessee for just over 21 years. And I've been with Nuveen for about 8.5. So married, 4 kids. That's me.
Well, thank you so much for making the schlep out to Chicago
You're
with
welcome.
us. We appreciate you. I want to get started a little bit. Well, let's talk a little bit about those acres then, right? So you
Sure.
said about 300,000 acres and a pretty sizable chunk, I would think. And I guess the first question I got for you, what goes into deciding what you acquire and how do you make choices about, well, we're going to buy this, we're going to acquire this farm, that kind of thing?
Yeah, sure. I'll start at 500,000 feet and
Thank
kind of
you.
work
Yes,
down.
I would appreciate that.
And I think it's an important kind of component of our business and gives some good context for kind of the detailed sort of due diligence and process.
Thank you.
Our business, which was founded as Westchester out of Champaign, Illinois, 1986, I think, was kind of the initial architect of institutional farmland management, right? And so had the benefit to join the firm while I'll call them the godfathers were still involved.
Oh,
and so,
that's good phrasing.
Randall Pope, Mark Couchman, Rory Robertson. I could go on, name 3 or 4 more. Martin Davies, our current CEO. All these guys were kind of involved with sort of the formation of this asset class, and it really starts with quality.
Okay.
Right. And so you can run whatever financial models you want. You can talk to whatever tenant partners or farm managers or what have you. But our investment thesis starts with quality and the fact that kind of quality will prevail through the cycle and then from one cycle to the next. And so we start with quality and then we start to dig into all the various details, the financial underwriting, cropping diversity and mix, breadth and depth of the tenant market in whatever region we're talking about.
Okay.
And then we look at things, I think, which is important, aligning that investment with a long-term hold, right?
Yep,
Which I think
absolutely.
in this asset class,
Absolutely.
there's plenty of pitfalls, and we've seen plenty of victims to the quick in and out, which rarely works. And so I think our weighted average hold period is probably around 16 years, and we always assume that we're going to ride at least a couple cycles. And so if everything lines up and it makes sense, then we push forward, and a lot of times we find reasons not to.
How has farmland appreciation changed the game, added to the game? Like, how have you seen acre prices in the last 20 years have risen fairly dramatically?
Right.
And contrasted to other asset classes, we've seen substantial appreciation of
Right.
an asset class that generally is considered safe, from a standpoint of return and consistency. How have you seen that appreciation change what y'all do or add to it? I'd love to get your perspective on that.
Yeah, sure. And so a bit of this kind of predates my experience in the asset class, but history likes to repeat itself, right? And
Yes.
so whether you're relying on NACREF data, USDA data, and obviously I'm just talking about here within the U.S., you can see kind of the similar sort of curve of the cycle, I'll call it, or the appreciation curve has taken place numerous times in the past. the numbers and the rates might look different, but the curve itself looks pretty similar. And we've been on this trajectory up, kind of meandering up and down from one cycle to the next. But the last 3 years have been, especially if you talk about the Midwestern states here in the U.S., appreciation has been just absolutely absurd.
Yeah.
Right? I mean, we're talking high teens to low 20% appreciation for back-to-back, if not back-to-back-to-back years. I mean, you want to talk about a compounding effect, and that's like lights out. It's not going to go on forever. We're seeing that kind of that normalization or kind of easing of the appreciation rates happen kind of live this year. You know, it's what farmland does. And so I think, and maybe this is where you're going, but the questions that we always get from potential investors and definitely from current investors, you know, is now a good time to buy or now a good time to sell?
Isn't that the $1 million question about everything?
Or the $1 billion question.
Even about houses, right? Like we get that farmland, you get that real estate.
Right.
Is now good. What about interest rates? How's it going to change? Should I wait? Like that that is the question du jour of this podcast.
Exactly.
And there's no right answer. And you know, the question is, look at your financial goals and buy accordingly. You know, there's no magic bullet.
Look at your financial goals. Look at your investment horizon, right?
Yeah, absolutely.
This is a illiquid asset. And so if you are in a position where you would like to put some money to work in alternatives, specifically farmland, but you've got a 4 to 5 year sort of time horizon, I would probably guide you to look elsewhere, right?
Right.
If you've got a 15 to 20 year horizon, does your cycle timing really matter? Yeah, it's going to influence your total returns, but we're talking about a relatively narrow range of potential returns if you are willing to kind of align your investment horizon with kind of the long-lived nature of the asset.
Well, let's talk a little bit about characteristics of the asset class. And if you don't mind sharing, you know, characteristics of tangent ones at Nuveen as well.
Sure.
You know, we're talking about other, you know, non-row crop agriculture products. You know, when we think about where the demand, be it institutional, be it family office, you know, for the product, do we see it matched up with equities and bonds? Like, where do we wind up seeing that as part of a bigger portfolio?
Yeah, sure. The answer is it depends, right? Okay, so let's talk about institutions first, and then maybe we move on to family offices, high net worth individuals, et cetera. You know, institutions are, I would say they're finicky, and we are one, right? And so we fully admit that our tastes change, and sometimes they change more rapidly than we think they will. But in most cases, our investors have huge pots of currency to invest, right? And so they are pensions.
There's a demand.
Right, there's a demand. And they are pensions, insurance companies, endowments.
Oh, yeah.
We're a single sliver of a very kind of finely cut asset pie. And so they are willing to kind of commit the dollars for an extended period of time, which is important.
Yes.
The family offices, I think, they're in kind of the get to know you phase of this asset class.
I think entirely. You know, you're starting to see that we've always looked at farmland and other types of real estate and institutional portfolios, endowments, right? That's not new. That's something that I would say 50s, 60s, somewhere in there, right? Became more mainstream.
Absolutely.
But, you know, as we're starting to see even that certified financial planner level client start saying, oh, it's private equity or, you know, real estate or ag, you know, how can I buy those things? You are starting to see that get to know you phase. I think that trickle is happening, and we're kind of in the middle of that. Yeah,
I think the big thing for what I'll call kind of I won't call it retail, because, you know, when you're talking about $1 billion family offices,
it's not really
exactly retail.
Maybe high net worth or something.
Right. They're trying to wrap their mind around kind of the investment horizon, right? I mean, so committing resources and dollars and patience for a 10 to 20 year timeline. In a lot of cases, they're also kind of thinking through generational sort of transitions, right, within their families. And
very much so.
You know, you might have a generation that loves the asset, the next generation not so much. I mean, especially when you've got like a lot of fun things like crypto and everything else going on. You know, liken that to like a kind of a bass lure, right? Something shiny,
Shiny and new, shiny and new.
So yeah, I think we're in that get to know you phase. We talk with a lot of family offices. We've had some great traction with family offices, and we've had some really good conversations with family offices that have resulted in, look, this asset is just not for us because we can't get our mind wrapped around,
the 15-year
exactly
cycles.
Yeah.
I love that perspective. Can you share a little bit about from the economic end of this? We're starting to see higher yields over decades when it comes to row crops.
Yep.
How is that from Nuveen's perspective? Is that, changing values or cash flows, or what are we looking at to that? And what's the kind of investment end of that?
Yeah, sure. I mean, fortunately, it's pretty simple, right? I mean, it's not even math. I've got a older friend that's a PhD in economics, and he tells me it's not even math, it's arithmetic, right?
Okay.
And that's what we're dealing with here, arithmetic. It's price times yield, right? And so,
sure.
The underlying cash flows from the property. But I think we've seen just tremendous increase in yield, primarily due to technology, whether that's equipment and or seed technology, genetics, et cetera. I think kind of the next wave from a yield standpoint is going to be a lot of what we discuss in the realm of ESG, sustainable ag, regenerative practices, however you want to label those, and what the potential impact on yield, favorable or not, might be as those practices are implemented.
Let's talk a little more about that, right? Because I think there's a lot of interest in ESG
Big
and
buzzword.
Everything from solar to wind.
Yeah.
And are we starting to see in those 300,000 acres, are we starting to see improvement? I mean, that kind of investment as well as row crop, or how does that work?
Yeah, absolutely. So one thing I would say, I mean, folks like to kind of romanticize perspectives, right? Or not
sure.
even perspectives, perceptions, right?
Absolutely. Right. Or spin them.
Yes. And so, I think it's clear that there's a camp that is not fond of institutional investment in farmland or potentially in real estate in general. There's also, I think, a view, and I did not come from a farming family, right?
Okay.
I'm here by choice, not by destiny. And there's often a romanticized view of what farming is like, right? I mean, it's like a Norman Rockwell sort of postcard.
Yeah.
Couldn't be further from the truth. And so what I think, if we look back at our own portfolio, and we've got some great, peers, I'll call them kind of our frenemies in terms of institutional farmland investors, the amount of resources that we can put into properties after we acquire them is just insane.
Well, you can transform,
average, right?
Right.
And so we spend, and hear me out here because I'm going to get back to kind of the specifics on ESG, but irrigation and drainage, right?
Yes.
On-farm storage, conversion of fossil fuel power, irrigation wells over to electric, right? I would view these as kind of layups. In a lot of instances, individual owners and families either don't have the resources, the financial resources, to just cut a big check really anytime they would like. Or there's multiple people pulling on the purse strings, right? We're able to make that happen. We're able to make it happen pretty rapidly. The same thing with ESG, right? We've spent just an inordinate amount of time over the last decade thinking through what is actually realistic, and what can be implemented across scale, right? And so, in a lot of cases, they're not real exciting to read about because it's everything like cover crops, looking at riparian buffers around perimeters of fields. That kind of gets old. You're not going to see it on the front page of the paper. And those practices make the biggest difference. We bring financial resources to the table where we can either give our tenants, some sort of kind of cushion as it relates to their operation for implementing new practices, or we can pay to have the things done on our own. And that's something that I think really differentiates the institutional community relative to kind of your standard individual ownership.
Well, and I think also the institutional community, when you look at the ability to improve farmland, right, to create higher yielding, but also have some ESG effects that we know over 20 or 30 years, the land will be better off for it.
Correct.
Than if we were farming without those investments.
Correct.
Right. So to some extent, you start to see ESG from the framework. Yes, we can spin it politically, But we can also look at it as far as we want this land to be more productive. We want it to be healthier. We want it to last longer. We want it to be able to have, return characteristics. And by investing in it, we're all better off.
That's right.
So I think on that end, it does drive me a little batty because there's wins to be had when you can invest in land. There's wins for everybody.
Sure.
Right. And I think the pushback you get, institutional investment in farmland. And I'm like, yeah, but you can create better land that way. So to me, that's a perspective that we can get our minds around a little better.
Yeah, I would say I would underscore your term batty. I would probably use another few terms, maybe not appropriate for the podcast. Yes. So I would say in general, even for folks, and I listened to one of the episodes of this podcast yesterday. I mean, even for well-educated institutional investors, there's still a mindset that like none of this stuff has ever been done before as it relates to ESG improvements, et cetera. And I think if you spend any time, and this kind of goes across geographies, right? I mean, we're invested in 6 sort of kind of core geographies across the states in our portfolio within row crops. Spend any time with growers in any one of those regions, and you're going to quickly figure out that, and I'm going to date myself with this reference, you're dealing with MacGyver, right? So if you remember, the show MacGyver,
I
like,
do. It's dating both of us, but I do remember.
I mean, it was syndicated on USA. It was like one of my go-to shows when I would have a sick day in elementary school.
Yeah, me too.
On any given day, a U.S. grower is going to wake up and they're going to be given like 8 inches of duct tape, some dental floss, and maybe a few other things, and it's like, okay, go save the world.
Innovation is critical.
And so over time, everything that we think is kind of new, and there is a lot of really new, exciting technology, new practices or whatever, but I would say 9 out of 10 times a grower has already tried or is already doing what we're talking about. And so that's a very, very important thing to note. We're evolving here. We're not starting. And so
that's a great perspective.
We try to figure out, we spend a lot of time talking with our tenant partners, and we've got 140 of them from coast to coast. I think 135 of them are farming families. Tell us everything that you've tried over the last 20 years that didn't work and why we're not going to try it again. And then let's think about the things that you'd be willing to try again if we would be able to kind of put some skin in the game and have some financial risk sharing.
Yeah.
And then let's go from there.
So that's a great model of innovation and allows some, trial and error, but over time the successes will pop up.
Correct.
And that's a really smart way to run it. What do you see as far as trends over the next decade? And I don't know if you could speak to if interest rates simmer and inflation simmer a little bit. How do we see that impacting row crops?
Yeah, sure. So maybe we'll start at kind of the short end of the curve here. Shock and awe, I guess, comes to mind as it relates to operating costs. For operators, and in our business, we partner with tenants. We have colleagues on the West Coast that oversee portfolios that we directly operate, right? And so we're seeing it from our grower partners. We're seeing it live from our own directly operated businesses. Just start with interest rates, right? I mean, if you just go back 36 months, the average operating line was probably, started with a 3 handle, and now we're pushing double digits in certain cases, certain regions. That's an absurd increase in just the overall
increase too.
Cost of operation.
Yes.
That is taking root, right? We got to find a way it only works if everybody makes money over the long term. So we've got to figure out how to kind of right size the new interest rate environment. And then from a commodity price standpoint, I'll reference exchange traded commodity prices. In certain regions, we've got specialty crops that are, a little bit more opaque markets. But clearly no one's excited about corn with a 3 in front of it and beans with a 9 in front of it. I mean, we're kind of, even for, what I'd call hyper efficient, large scale growers, we're at kind of borderline break even, marginal costs. And, that's part of the cycle. We've been there before, think through kind of the late teens. And again, we got to figure out how to make this work over the long term for everybody.
Yes.
And so,
yes.
I think we're headed into that period where we're going to see some softening in asset prices, and it needs to happen, right? I mean, especially after, the whirlwind that was COVID. Bruce did a great job on one of the episodes, just talking about kind of the difference between COVID and then looking back at kind of the GFC, right? I mean, two totally different kind of inflection points. But I still think we're in kind of that normalizing period post-COVID, and we're finally out of what was 14 years of literally no yield across the global economy. And so this kind of normalization needs to happen. But if you think through kind of the macro drivers of farmland values, I mean, we're feeding more people.
Yes.
Whatever the data point you want to pull, we need something between 20 and 50 million more farmland acres just today to satisfy demand. Transition over to more protein-oriented diet, obviously like the renewable stuff. So we have all these macro trends that are not 10-year trends. These are 100+ year trends, right?
Right.
And I think that's the thing that we keep coming back to, right? Let's not get lost in the moment of this year or next. Let's find those quality investments that are going to be able to kind of ride those 100-year trends that we are seeing pan out.
I love that answer. That is fantastic. We'll definitely go in the classroom.
Long-winded, but
it's a good
sorry.
One. So I want to kind of close our convo with this point and get your take on it. You've got, let's say, a property casualty agent role, right? You've got an investment advisory firm, and they've got some clients. Either way, you've got a registered rep, and they're evaluating working with the client. The client either has an interest in farmland, they maybe have an interest in investing, maybe owning directly or owning, some other asset with that exposure. What advice do you give that financial intermediary? Like, how can they better learn about this asset class? How can they become more prepared to give advice? What characteristics, from where you sit, how do we educate that salesperson or that advisor a little better?
Short answer is it's tough, right?
Yes, it is. It's very niche.
It's like a niche within a niche. And then it is ridiculously illiquid. And so, as I think as numerous people have pointed out, it's hard to buy. It's one of those asset classes where in certain times it's even harder to sell, which presents a predicament. So if I'm on the other side of the table, and so like, here's a good perspective.
Okay.
We're owned by TIA. We roll up under Nuveen, which is kind of the large intergalactic third-party asset management business. Nuveen acquired, I think, in 2014. But TIA represents a lot of folks in academia, right?
Sure.
I've got an aunt and uncle live in Lexington, Virginia. Both worked at Washington and Lee for the last kind of chapter of their professional careers. Two of the greatest people I know, right? If I'm sitting on the other side of the table and I'm trying to educate them about their underlying investments in farmland or why it makes sense, one, I'm going to keep coming back to just know your customer and alignment, right?
Yes.
So if you have $50,000 and you're thinking about where to deploy it, I would probably tell you, don't go try to do some kind of one-off farmland deal, right?
Right.
At 50 grand, you've got no scale. Who's going to manage it for you? If someone does want to manage it for you, that's going to be expensive, right? So let's think about the more kind of liquid traditional routes where you can get the exposure, but you can still get yourself out if you need it.
Yeah.
So you've got alignment. And then two, I keep coming back to it, patience.
Alignment and patience.
And so we've had a lot of yield hunters that have come into farmland over the last decade, clearly for reasons I think we all know between the GFC and COVID. I think we see a lot of exits, and that's money that was just there, didn't really ever care to know about the assets themselves. They just wanted the yield. Interest rate environments changed.
Right.
They can go park their money in a money market fund. And so having the patience to again ride a cycle or two, and it's going to work out for you. There's just going to be dips in the road that you're going to have to weather. And then lastly, just think about diversification, right? So
Absolutely.
if you are
Absolutely.
If you live in Champaign, Illinois, and you are comfortable with everything you see, within 5 minutes of leaving town, I would say, you're probably a great candidate to invest in Midwest farmland. If you are sitting in the middle of Chicago or Manhattan or San Francisco, never seen a farm in your life, just want some exposure because you've read all about it, I would probably guide you towards some sort of vehicle that has everything we've already talked about, but some element of diversification. So permanent versus annual plantings, maybe some international exposure, something that kind of tempers the volatility of those cycles in any specific region.
Well, I think that is a fantastic answer. I appreciate it. And I think that when we look at patience and diversification and time horizon, all that plays into what any financial advisor should consider with their customers and clients when we look at liquid assets. And it just goes back to that hypothesis, I think, that quality drives it. And, I think from a financial planning perspective, it's got to be conversations about goals, time horizons, what the end game is. And when we look at farmland, even more so than when we look at equities.
It's the same conversation we have with folks that want to put billions of dollars to work, that folks that want to put thousands of dollars to work, right?
It's a uniform convo.
Yep.
Well, I appreciate your time. Thank you so much for coming.
Thanks for the invite.